IMF has projected that more than 1/3 of the global economy will contract this year or next year. While no country is spared the ill effects of such large shocks, emerging market economies, that is EMEs in particular, the ones dependent on food, energy and commodity imports, have been the worst affected. Looking beyond the pandemic and the war, fragmentation in trade, finance and technology is also adding to the forces of deglobalization. Supply chains are being redrawn on considerations of geopolitical security, leading to what is now come to be known as reshoring and friendshoring. Food and energy security, together with climate change, have become the biggest challenges to the world. In this hostile international environment, the Indian economy remains resilient, drawing strength from its macroeconomic fundamentals. Our financial system remains robust and stable, and corporates are healthier than before the crisis. Bank credit is growing in double digits for 8 months now. India is widely seen as a bright spot in an otherwise gloomy world. Yet, our inflation remains elevated, as in most parts of the world. Global spillovers continue to impart volatility and uncertainty. Let me now focus on the deliberations and the decision of the Monetary Policy Committee meeting, and this is something which I think the key thing about which the market is eagerly awaiting. Now, the Monetary Policy Committee meeting met on 5th, 6th and 7th December. Based on an assessment of the macroeconomic situation and its outlook, the MPC decided by a majority of 5 members out of 6 to increase the policy repo rate by 35 basis points to 6.25% with immediate effect. Now, I think this is one occasion where the market expectations and the decisions of the Monetary Policy Committee are by and large aligned. And there are several interpretations whether when the market expectation and the monetary policy decisions are aligned, whether they are, they have to be taken as a perfect monetary policy or otherwise, but that debate can happen some other time. Now, consequent to this increase in the policy repo rate by 35 basis points, the standing deposit facility, that is the SDF rate, stands adjusted to 6% and the marginal standing facility rate and the bank rate to 6.5%. The MPC also decided by a majority of 4 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. Let me now elaborate on the MPC's rationale behind these decisions relating to the policy rate and the stance of the monetary policy. Growth prospects across the world are dampening. Financial markets remain nervous and are characterized by high volatility and price swings. For the Indian economy, the outlook is supported by good progress of rabi sowing, sustained urban demand, improving rural demand, a pickup in manufacturing, rebound in services, and robust credit expansion. Consumer price inflation moderated to 6.8% year-on-year in October as expected, but still it remains above the upper tolerance band of the target. Core inflation is exhibiting stickiness. While headline inflation may ease through the rest of the year and in first quarter of 2023-24, it is expected to rule above the target. The medium-term inflation outlook is exposed to heightened uncertainties from geopolitical tensions, financial market volatility, and the rising incidence of weather-related disruptions. On balance, the MPC was of the view that further calibrated monetary policy action is warranted to keep inflation expectations anchored, break core inflation persistence, and contain second-round effects. I would read this sentence again. The MPC was of the view that further calibrated monetary policy is warranted to keep number one, inflation expectations anchored. Number two, break core inflation persistence. And number three, contain second round effects. These actions will strengthen the medium-term growth prospects of the Indian economy. Accordingly, the MPC decided to increase the policy repo rate, as I have said, by 35 basis points to 6.25% and to remain focused on withdrawal of accommodation while supporting growth. As regards the stance of the monetary policy, the MPC took a holistic view of the policy rate and the liquidity conditions relative to inflation. Adjusted for inflation, the policy rate still remains accommodative. Over the next 12 months, inflation is expected to remain higher than 4% target. System liquidity remains in surplus with an average daily absorption under the liquidity adjustment facility, that is LAF, of 1.6 lakh crore in November this year. The overall monetary and liquidity conditions remain accommodative, and hence the MPC decided to remain focused on withdrawal of accommodation. I would now like to provide our assessment of growth and inflation. First, I will take up growth. According to the latest data released by the National Statistical Office, that is NSO, the real gross domestic product posted a growth of 6.3% year-on-year in the second quarter of this year, driven primarily by private consumption and investment. This also is in line with our expectations. Going into the third quarter of this year, economic activity continued to gain strength in the month of October. Urban consumption firmed up further, driven by sustained recovery in discretionary spending, especially on services such as travel, tourism and hospitality. Passenger vehicle sales and domestic air passenger traffic posted robust year-on-year growth. Rural demand is recovering as reflected in the pace of tractor and retail two-wheeler sales, with rising farm activity. Investment activity is also gaining traction. Non-food bank credit, and this is something very important, non-food bank credit rose by rupees 10.6 lakh crore during April to November as compared with an increase of 1.9 lakh crore last year. The total flow of resources to the commercial sector, expanded by rupees 14.7 lakh crore during this year up to November, as compared with rupees 6.8 lakh crore in the same period last year. On the other hand, the drag from net external demand further accentuated in October as merchandise exports contracted by 12.1% year-on-year. After expanding...
All right, so the RBI there announcing its monetary policy, and as expected, they're up by 35 basis points, so a hike in interest rate by 35 basis points.